Hi everyone and welcome to this new Tower Markets webinar. My name is Orso Giordi Locatelli and it's a pleasure to be with you today as we dive into the technical landscape of the major markets I follow week after week. Before we begin, please note that this webinar is for education purpose only and does not constitute financial advice. We are here to learn, observe price action, and explore market scenario together in a structured, professional way. Also, I'm proud to share that Tower Markets has recently been awarded by the International Business Magazine in the UAI, a sign of recognition for our continued effort to empower trades with real actionable tools and insight. Before we start, I want to ask to read the risk warning for a few seconds, please. So, start. This is the webinar, so the about reactions, breakouts, and pullbacks. We start with euro dollar, so euro dollar markets. The euro dollar pair is once again testing very important area, the April 21st high, which has now become a critical pivot point for both bulls and bears. On the weekly charts, we are looking at a market that has been in a 6-bar bull micro channel. That means we've seen 6 consecutive weeks of persistent buying with little to no follow through from the bears. That alone is a strong signal of bullish control. But this week, we chart give us an inside doji closing in the middle of its range, which is a sign of hesitation. Bulls had a chance to break out above the April 21st high, but so far that breakout attempt looks weak. Price is overlapping with last week's range, and the market is stalling right at resistance. Now the bulls still want to complete a wedge pattern, with the 3 legs being March 18th, April 21st, and the current June 12th high. They're aiming for a breakout above the range and a measured move that could target the 2021 high area. But here's the key. For that to happen, they must show strong follow through. That means big, clean bull bars closing near day highs and a clear break above April 21st. In the market just keeps stalling in this zone with overlapping candles and long wicks on top. The bulls lose momentum and the odds of a higher high major trend reversal will start to increase. That's exactly what the bears are hoping for. They see this current move as a retest of April 21st high and want to build a case for reversal, either from a wedge or from a double top. Their goal is to trigger a failed breakout and push the market back to the middle of the trading range. So, what do we watch now? If there's a pullback, bulls will want the 20-week exponential moving average or the May 12th low to hold at support, ideally forming a double bottom bull flag before another attempt higher. If, on the other hand, the bears manage to create strong bear bars with follow through, then we could see a deeper leg down into the heart of the range. Zooming in on the daily chart, we get a clearer sense of the current struggle. This past week has been sideways with no real conviction. Tuesday's small pullback near the 20-day exponential moving average didn't trigger any major selling, and Friday's section remained weak. The bulls are still pushing for a breakout, but again, without strong consecutive bull bars trending above April 21st, it won't be enough. The bears see a wedge forming inside the third leg with May 21st, June 15th, and June 12th as the reference points. And they'd love to turn is into a failed pattern, a double top with the June 12th high is on their radar too. So, bottom line, we're at a decision point here. Either the bull step in a breakout clean move April 21st with follow through buying, or we stall again and likely see a TBTL pullbacks, so the 10 bars, two legs, back toward the middle of the range. For now, the market is pausing, and when price pauses at resistance, it's not enough to be bullish. We need proof, and until we get that, I'm staying cautious here. So jump up to Bitcoin. Let's take a look at what's going on with Bitcoin in the last 2 weeks, which just triggered a low to set up on the weekly charts. And interestingly, this low 2 also happens to be the candle handle in what looks like a larger cap and handle pattern. To give a bit of context, Bitcoin spent most of 2024, about 8 months, trading inside a wide range. Then we finally got a breakout above the top what range, followed by a strong move up that completed a measured leg. But earlier this year, that rally ran into resistance. A double top formed, and the market reversed sharply with a big bear surprise bar, enough to temporarily flip the trend into always in short mode. Now, here's where things got interesting. Despite the strong bearish breakout, follow through to the downside was very limited. There was a large tail below the next candle's close, indicated buying pressure, and price quickly worked its way back into prior double top zone, effectively closing the bear breakout gap. That's now what bears want to see. We also had an important support zone just below, the 2024 breakout point, which aligned with the 12-month moving average. That kind of technical confluence tends to attract institutional buying. And right on cue, rebalancing flows in Q1 2024 and 2025 added demand, especially with price down 30% from the previous quarter. That's when we got a late I3 setup, a classic pullback entry, followed by a strong bull reversal that flipped the market back into always in long. So the market recovered fully from the bearish breakdown, and at that point, in cup and handle structure started to merge. From a behavioral point of view, this is important. Once the market flips directional, this clarity, it tends to stay that way at least for a while. Reversal become much harder after strong shifts. And that brings us to this week. The market has pulled back again, forming a low 2 sell setup, but given the strength of the prior bull leg, this setup is not that attractive for bearish. In fact, the context is still favor to the bull. We are currently in a tight bull channel, and this pullback should easily fade and lead to the next breakouts. Bulls are still targeting major move up to around 120,000, which is in projection for a while higher time frame pattern. Some aggressive bulls may even be buying this pullback using limit orders, possibly scaling lower, as long as the overall structure doesn't break down. But there's a limit. If the pullback goes too deep, say a full 50% retracement of the bull leg, it could sign a shift into sideways market and weaken the bull thesis. Now looking at the daily chart, we can see the evolution more clearly. We had a spike and channel bull trend, which eventually broke down through its lower trend line. But, and this is the key, it didn't turn into a bear trend. That's typically. After strong bull trends, market usually goes sideways, not straight into reversal. Right now, price is inside a well-developed trading range with a clear three-leg structure: initial bear leg, rebound, and the current pullback. Statistically, about 80% of trading range breakouts fail, which makes a deep breakdown from here unlikely. Also worth nothing, below the current price this sits a bull breakout gap away, an area where bulls previously stepped in aggressively. That zone, along with the $100,000 round number, provides strong technical support. Bears haven't shown real commitment yet. There's no micro gap from the top of the range, and the last leg down lacks even energy. Even if we dip lower, buyers are likely to step in, especially near or just below strong looking bear bars, which is what we're seeing right now. So overall, we're in a range bound market with bullish space. No big move are expected in the coming days, maybe a 4,000 range at most. And unless something dramatic changes, the next breakout attempts will likely come from the bulls. Now let's move on to crude oil that is under the radar because there was war, the Trump's news, etc. Where the market remains looking inside a large trading range, but with the bulls now pushing toward the top of the range. On the weekly chart, this week printed an inside bar, a bear bar closing in its upper half with a long tail below. That tail suggests some buying pressure stepping in early in the week, and we've been showing grinding higher since then. We are currently trading around the upper third of the range, which, as I've said many times, is typically where sellers start getting active in range bound markets. In fact, most traders right now are following the BLSH approach, buy low, sell high. And until we get a clean breakout, the strategy remains in play. That said, bulls do have momentum to their side. They recently created a strong bull spike that retested the upper boundary, and now they're hoping to convert these into a successful breakout, targeting a major move based on the target of the range. That would project move well above the $80 zone. But for that to happen, we need follow through. Bulls have to print consecutive bull bars closing near their highs to convince traders this isn't just another fake out. And to break the pattern to reversal we've seen so many times before. Now, from the bear side, this is still being interpreted as a bull leg without a trading range, possibly a buy vacuum up to resistance. Bears believe we are approaching a sell zone, and their job now is to create strong bear bars to push the price back toward the middle of the range, near the $67 magnet level. Looking at the daily chart, we structure becomes even more clear. We've got a tight bull channel, 12 bars in a row, climbing steadily, and that's a strong signal. But it's also a little climatic, meaning it could be vulnerable to be a strong pullback. Friday's candle formed a bull bar, but with a no long upper wick, showing hesitation near the June 13th high. That area now looks like it might from a short-term double top. If a bull pullback does come, bulls will be watching the 20-day exponential moving average as their first line of defense. If we get a bounce there, it could from a higher low and continue the uptrend inside the range. Now, beyond the charts, we also have to acknowledge what's happening in the real world. And right now, geopolitical tension is back on the radar. We have seen renewed fighting in parts of the Middle East, particularly in oil-sensitive zones. Some ceasefire agreements are holding, others are breaking down, and the headlines are shifting day by day. On top of that, production uncertainty from the OPEC Plus members continues to full fuel of volatility. So, what does this mean for us as traders? It means extra caution and higher potential for news-driven spikes. A sudden headlines about a pipeline, a draw attack, or a failed base stock could push oil up or down several dollars in minutes. This makes breakout trading especially dangerous right now unless you have a very tight risk plan. In this environment, I prefer to treat crude oil as still range bound with bullish base short terms, but feeding strength near resistance and watching closely for signs of reversal or exhaustion. So, in summary, bulls have made a solid move back to the top of the range. Bears see this as a typical bull leg with a trading range and are waiting to fade it. The key level is $67, the magnet in the middle, and we are likely to return there unless the bulls can finally break out with strength. Geopolitical risk remains a valid card and could invalidate any technical setup with the minutes. Let's see how this plays out next week. But I'd be cautious by buying strange up here unless we see a clear breakout confirmed with follow through. So let's wrap to today's session with a look at the Standard & Poor's 500 A-mini futures, which is currently sitting in a delicate spot, a potential inflection point between trend continuation and deeper pullback. Looking at the weekly chart, this week we had a bear bar closing near its low with a long tail above. It traded below last week's low So technically it's a bear entry bar, but not a particularly strong one. Why? Because the candle overlaps the previous week's range. That tells us there's no real momentum yet, just hesitation. From the bearish perspective, this current move is being viewed as a retest of the December 6th all-time high and potentially the start of a lower high measure trend reversal. They're also pointing to a possible wedge pattern forming with legs on May 2, May 19th, and June 11th. If that structure holds, we could be in the early stage of a TBTL 10 bars, 2 legs down, which would mean a multi-week pullback. But again, bears need to show more than this. They need strong consecutive bars that push below the 20-week exponential moving average and break the rising trend line. Without that, any attempt at a reversal is likely to fall. On the bullish side, the case remains solid. Bullish continue to view the April 7th pullback as a major higher low, and they've already built a broad bull channel since then. They want to retest and break out above the December 6th all-time high, and they're treating any short-term weakness as a just pause in the trend. Even if we get a deeper pullback, they'll be watching levels like the 100-week exponential moving average of the April 30 low as potential support areas. Good spots for a larger higher low major trend reversal. And we need to keep in mind, while this week's bar was bearish, the market likely remains always in long bullish pressure since April has much been stronger than anything the bears have shown. We've seen solid bull bars, tight channels, and very limited follow-through sellings. That said, we are starting to see some loss of momentum. The last 6 weekly candles have had overlapping ranges, a sign that the trend might be getting tired. It's reasonable to accept a pullback soon. It could be shallow, maybe 1 or 2 bars, or something more significant, perhaps even a 50% retracement toward the 500,000 area. Zooming into the daily charts, price is still hovering above the 20-day moving exponential moving average. Monday started with a gap up to retest the June 11th high, but the rest to the week was more sideways way to the down. Friday touched the 20-day exponential moving average, but so far there's no clear breakout. Bulls still control the structure. The move from April 21st low was a tight bull channel, and unless bear can break convincingly below the 20 or 200-day moving exponential moving average, we are likely to just continue sideways or resume higher. From a training point of view, here's what I'm watching. It's bears create a strong consecutive bear bars, especially breaking through the May 23rd lows and the 200-day exponential moving average. That could be the start of something more significant. But if the pullback remains shallow and choppy, and price holds around key averages, the next leg up could start from there. In conclusion, we're in a waiting zone. Bears have a chance here, but they need to act fast and with strength. Bulls still own the bigger picture, and unless provide otherwise, the trend is still intact. For now, it's all about follow through that the bear take control with conviction, or the market just digests recent gains and prepares for another push higher. All right, that's wrap up for the technical review for today. We've covered all four major assets: euro dollar, Bitcoin, crude oil, and the Standard & Poor's 500. And as you've seen, we're at the key decision points across the board. Whether it's breakouts trying to confirm or pullbacks that could either deepen or fall. The next few sessions are like to be very revealing. As always, stay flexible, respect the levels, and let the price tell you the story. The goal isn't to predict, it's to react with clarity and structure. If you're watching this live and have questions, feel free to drop them in the chat now. And if you're watching the replay, I catch you again in 2 weeks for the next session. Same time, same place, right here with our markets. Thanks again for joining me, Trey Smart, and I'll see you soon. Bye bye.